Hey guys, Daniel here with Value Investing with Daniel. In this video we're going to be discussing the value creation matrix and really what it means in terms of enhancing the earnings power value of a company. So to start, let's discuss together what the earnings power value of a company is. So let me just clear this out here, just move it over to the side. So what the earnings power value of a company basically is, let's write it down, EPV, earnings power value, is the essentially the sustainable free cash flows of a company, so the average sustainable free cash flow of a company, the average sustainable free cash flow of a company divided by some rate of return that you're looking for in terms of your investment. Usually this rate of return, which is basically the cost of capital, is going to be somewhere between 8 or 7 and 13% depending on the company. Now, so the earnings power value is equal to this here. The average sustainable free cash flows of the company divided by your rate of return, which is going to be between 7 and 13%. Okay? Between 7 and 13%. So what does this mean? This means that if we look at a company like Home Depot and we look at their free cash flows, and let's use their average sustainable free cash flows over the last 5 years, we get 12.4 billion. You see that here? This is the free cash flow annual average over the last 5 years. So 12.4 billion would be considered the average sustainable free cash flows for the company, right? So if we go back to paint here, we can say that, let's say in Home Depot's case, this would be 12.4 billion in terms of the average sustainable free cash flows. And what we would do is we would divide that by our desired rate of return, which would be somewhere between 7 and 13%, and that would give us the earnings power value. Now, determining which number you use between 7 and 13% is going to depend on the characteristics of the business in question. You have to think of it sort of from a holistic perspective. Home Depot is a company with not a lot of debt, so that's a bonus. If it had a huge amount of debt, we would use a higher discount rate. It generates consistent and stable free cash flows, so we could use slightly lower. But it's retail, so we can go slightly higher. So what I'm saying is when you choose your discount rate, it's very difficult to be precise. If you look at, for example, like Alpha Spread here, they go out to the second decimal place in terms of calculating the weighted average cost of capital and the cost of equity using the capital asset pricing model. This is largely academic nonsense. They are roughly accurate in approximating it, but there is no way you can determine what your actual cost of capital is. Only you can determine that for yourself. And that's the beauty of the earnings power value here, is that you're choosing a number between 7 and 13% most of the time. Let's talk about a very safe company, something like Procter and Gamble, for example. They make products, household consumer defensive products. They have very little debt. They have, so for a company like that, and they're not really like retail, it's not like they have like stores, so for something like that, I would say 7% discount rate would probably be 7 or 8%, let's say. But then you look at something like, maybe you go back like 10 years and you're looking at Bed Bath & Beyond, you would probably use a higher discount rate because it's retail, or you look at the debt position. If a company has a lot of debt, you're going to go up even a little bit higher. So usually with my discount rate, I start at about 10%, and then I say, okay, low debt, we can go down to 9. But it's retail, so I'm going back up to 10, and they have a little bit cyclicality in their earnings, so let's go to 11. So I always try and gauge based on the most important factors, which is usually going to be the debt, the nature of the business, and so on. So just something to keep in mind. In terms of Home Depot, I would say 7% would be too low, 8% still sounds a little bit low. I would feel comfortable somewhere like 9-10% for Home Depot. So let's say we use a 10% or a 9% discount rate in this case, right? So let's just say for Home Depot's case, we're going to use a 9% discount rate because to me that sounds right. That's what I'm comfortable with, so that's what I'm going to use. If you really don't like the fact that it's retail, maybe you decide, hey, I'm going to use a 10% rate. It's totally up to you, whatever you choose to use. So What this is saying here is we got 12.4 billion in terms of the average sustainable free cash flows, and our cost of capital is 9%, right? So let's put that into the calculator here, divided by 9%. What this 9% represents means in your first year, assuming there's no growth in the free cash flows, you want 12.4 billion to represent a 9% upfront return to you, right? So if 12.9 billion were 12.4 billion represents a 9% return, then that means the company is worth 138 billion. So what this is the earnings power value. This means if we maintain the average sustainable free cash flows into the indefinite future, and our cost of capital is 9%, then the company, in terms of its sustainable free cash flows, is worth $138 billion. So this would be considered the earnings power value. This is the non-growth value of the free cash flows. If we were to use a higher discount rate, it would be worth less, right? So if we said for Home Depot, we want to use an 11% discount rate, well, now it's only worth $112 billion. The beauty of this formula is, even if you're off, like let's say I say, it's only, I think the discount rate is 11%, right? 12.4 divided by 11%. That gives me 112. Well, 100 or 113 is not that different from 138. So even though I'm off, I could be 2 percentage points. I just have to be in the rough area in terms of the cost of capital. Plus or minus 2 percentage points. I don't have to be super precise to the second decimal place like the academics say, okay? As long as you're plus or minus 1 percentage, 2 percentage points, you'll be okay, because this is just an approximation trying to come up with the value of the companies in terms of its average sustainable free cash flows, okay? So this is what the earnings power value of the company is, 138 billion. This is saying we're using its average sustainable free cash flows. This is what we think it's worth. Now, for franchise type businesses with a moat or a dominant competitive advantage, where the company is able to deliver high returns on capital above the cost of capital, we can enhance this earnings power value by multiplying it by the value creation factor, okay? So the value creation factor is this here, which is, this formula here is the value creation factor, okay? Which is the return on capital times basically the retention ratio divided by the cost of capital, okay? So the value creation factor is what we multiply to our earnings power value, and this is the value creation factor formula here. Our return on capital times the amount of money, the percentage of the money that's reinvested back into the business year after year, divided by the cost of capital. So let's walk through this together, okay? Our return on capital for Home Depot, if we look here in terms of its return on capital employed, on average over the last 5 years is about 51%, okay? So let's just use 50%, okay? So let's go back to paint here. Let's say it's 50%. I'll use the same color, that way we can see very easily. 50% is the return on capital. Now, we have to multiply this 50 by the percentage of the money that they make every year in terms of free cash flows that are reinvested back into the business, which is basically going to be this free cash flow number, average sustainable free cash flows, minus the average dividends paid over the last 5 years. So let's do that together. So we know that over the last 5 years, they made 12.4 billion in free cash flows. Remember, this is what we said right here, 12.4 billion. And that's basically this number here. So we have to see what of that did they pay in terms of dividends. And we see total dividends paid was 6.1 billion. So if we take our 12.4 and we minus the 6.1, that means year after year, they reinvest $6.3 billion back into the business. That is what they reinvest back into the business year after year. So what we can do is we can take this 6.3 divided by 12.4. So what we're doing is we're saying, okay, they reinvest 6.3 billion out of the 12.4 billion dollars that they make year after year. What percentage is it that they're reinvesting? And they're reinvesting 51%. So this means that of all the money that they make, they reinvest 50% of it back into the business. Of that money that they reinvest, they earn 50% per year on it in terms of their return on capital. So the 6.3 here is the free cash flows reinvested back into the business, right? And the 12.4 is the total free cash flows, and this represents the amount reinvested. The reinvestment rate is 51%. So let's go to paid here, times 51%, divided by, now, the cost of capital. And this cost of capital is going to be the same cost of capital that we used in our earnings power value calculation. So 50 times 51, I mean, we don't have to be super accurate. We know this is going to be, 25%. So let's just say 25. Okay, we can always round, up or down. It doesn't matter because none of this is super precise. These are just approximations. So 50 times 50% roughly is 25, divided by our cost of capital of 9%, which we determined sounded fair for us for Home Depot. 25 divided by 9 gives us 2.8. Okay. So 2.8 is our value creation factor. So let's review. Our earnings power value, which is a conservative estimate of the value of a non-growth business, okay, is the average sustainable free cash flows of the business divided by the cost of capital. If the cost of capital is usually going to be somewhere between 7 and 13%. It's going to depend a little bit on interest rates, but this is usually where it's going to be around 90% of the time, okay? It's up to you what cost of capital you choose. Depends how comfortable you are with the business. But you should never compensate for a lack of understanding of the business by using a higher cost of capital. I don't believe in that. Your cost of capital is going to be depending on the characteristics of the business and the financial position of the business, like the debt position, okay? If they have a lot of debt, use a higher cost of capital. If they're more cyclical, use a higher cost of capital. Maybe if they're in retail, use a higher cost of capital. But if they don't have those characteristics, now you start to go lower and lower. If they're in a sector with changing very fast technologies, use a higher cost of capital. If they're in something stable like Procter & Gamble, use a lower cost of capital. So it's just, you come up with a rough number, okay? So we said 12.4 billion was the average sustainable free cash flows of Home Depot. The cost of capital we estimate is probably around 9%. We came up with a earnings power value for the company of 138 billion. Now, because Home Depot has a moat or a dominant competitive advantage, meaning it's able to earn a return on capital substantially higher than its cost of capital, what we can do is we can multiply this earnings power value by the value creation factor. The value creation factor, and remember, we only multiply the earnings power value by the value creation factor if the cost of capital is substantially higher and consistently higher above if the return on capital is consistently higher above the cost of capital. Value creation factor is the return on capital multiplied by the percentage of the free cash flows that are reinvested back into the business and not paid out as dividends. So our return on capital for Home Depot was 50%, our cost of and the reinvestment rate was 51%. So that gives us about 25%, and we have to divide that by our cost of capital, which we said was 9%. That gives us a value creation factor of 2.8. Now, what we do here is we take 138, which was our earnings power value, multiplied by our value creation factor. So 138, let's clear this here, 138 earnings power value times a 2.8 value creation factor gives us an intrinsic value approximation of $386 billion for Home Depot. Okay? Now, like I say, if you use a slightly higher cost of capital or slightly lower, you might get different numbers, but this is roughly where the range you're going to fall into. If we look at the current enterprise value of Home Depot, we see that it's roughly trading at a little bit below this intrinsic value calculation. Maybe not enough to justify a purchase, but we can see that if Home Depot falls, another 10, 20, 30%, maybe we feel comfortable in making the purchase. And if you look at my previous video on the Home Depot valuation that I did, I said that, Home Depot would deliver a 15% annualized rate of return approximately. Generally speaking, we're looking at 20% rate of return. And if the price of Home Depot falls 10, 20, 30%, we would get that. So that's showing that even though I use a different method in the previous video compared to this one, they're both showing that Home Depot seems to be decently priced and seems to be a good business. So it's just something to take into account. I hope you enjoyed the video. Be sure to give it a like. And if you have any questions, you can always ask in the comment section down below. Thanks.